Hey there, and welcome. Today, we are going to tackle one of the most fundamental, most powerful tools in any trader's toolkit, the moving average. Seriously, if you've ever looked at a price chart and just felt completely overwhelmed, you are in the right place. We're going to break it all down. Yeah, let's be honest. For anyone just starting out, a financial chart can look like total chaos, right? It's just this jagged line zipping up and down, and trying to figure out what it all means, it can feel impossible. Well, what if I told you there's one simple line that's designed to do just that? That's exactly what a moving average is for. It's this beautifully simple tool that literally cuts through all of that noise, smooths out the price, and gives you a much clearer picture of what the market is actually trying to do. So here's our game plan for today. First up, we're going to get a really solid handle on what a moving average even is. Then, I'm going to show you how to use it to read the market's trend. After that, we'll look at how to spot when that trend might be turning around. And finally, we'll cover how this one line can act like a moving floor and ceiling for the price. Sound good? Let's go. Okay, let's dive right in. Part 1. What in the world is this line we keep talking about? Now, it might sound a little technical, but the idea behind it is incredibly simple. A moving average just calculates the average price over a certain number of days or candles. So a 20-period moving average, it's just the average closing price of the last 20 periods, all plotted out as one single smooth line on your chart. Seriously, that's all there is to it. Now, you can set the moving average to any period you like, but these four are kind of the greatest hits. Shorter ones, like the 20, they react really fast to price changes, which is great for seeing the short-term trend. And the longer ones, like the 200, move a lot slower. They give you that big, zoomed-out picture of what the market's been doing for a long time. Okay, so we know what it is. Now for the really useful part. How do we actually use this thing to figure out which way the market is heading? We've got 3 super simple but really effective techniques for this. First, we're going to look at where the price is compared to the line. Second, we'll check out the angle or the slope of the line itself. And third, we're going to unlock a really cool trick by using 2 moving averages at the same time. So this first technique, it's the simplest one. And honestly, it's often the most powerful. If the price is consistently staying above that moving average line, guess what? The trend is up. And that means you should be looking for chances to buy. And if the price is consistently hanging out below the line, the trend is down. Your job is to look for selling opportunities. See? Super straightforward. But what happens if the market isn't really going up or down? Well, in those choppy sideways markets, you'll see the price just whip back and forth, over and under the line, kind of like a pendulum. And when you see that happening, it's a huge sign that there's no clear trend, and probably the smartest thing to do is just sit back and wait. Alright, technique number 2 is even easier. You just look at the angle of the line. Think of it like a hill. If you see a steep slope, like a 45-degree angle pointing sharply up or down, that's telling you there's a really strong trend with a lot of power behind it. But if the line is kind of flat, a gentle slope, that suggests the trend is weak. It's a great way to gauge the market's energy. In our third technique is to add a second, longer-term moving average. This is such a great trick. Think of that long-term MA, like the 200, as the main current of a river. It shows you the most powerful, dominant direction. Trading against that's like trying to paddle a canoe upstream. It's probably not going to end well. This helps you stay on the right side of the market. Okay, so we know how to find the trend. Awesome. But we all know markets don't go in one direction forever. So the big question is, how can we use these lines to see when the tide might be about to turn? Now, you could just wait for the price to cross the line, but that can give you a lot of fake outs. A much more reliable way is to watch for something called a moving average crossover. This is where we use 2 MAs, a short one and a long one, and we wait for the lines themselves to actually cross each other. And here's the famous one, the bullish crossover, better known as a golden cross. This happens when the faster short-term average climbs up and crosses above the slower long-term average. It's a huge signal that the short-term momentum is shifting up and a brand new uptrend could be starting. And on the flip side, of course, we have the bearish crossover, also known as the death cross. This is the exact opposite. The speedy short-term average dives down and crosses below the slow long-term average. This is a big warning sign that weakness is taking over, and the market might be about to roll over into a downtrend. Alright, let's get to one of my favorite and one of the most powerful uses for a moving average. Using it as a dynamic area of support and resistance. It's like having a moving floor and ceiling that travels right along with the price. Check this out. In a nice, healthy uptrend, you'll often see the price pull back to the moving average and then bounce right off it, like it's a floor holding it up. Those bounces can be amazing spots to look for buying opportunities. And in a downtrend, the opposite happens. The price rallies up, hits the line from below, and gets rejected, like it just smacked its head on the ceiling. Those are great areas to look for potential sells. So let's just boil it all down, shall we? The moving average is just this incredibly versatile tool. We've seen how to use it to identify the trend's direction and even its strength. We've seen how to use crossovers to get an early warning about trend changes. And we've seen how the line itself can act as a dynamic floor and ceiling. Not bad for one simple line, huh? And there you have it. The moving average, totally demystified. You now have a solid foundation for using one of the most popular indicators in the world. But the best way to really learn this stuff is to go do it. So go on, pull up a chart, any chart, and see if you can start spotting these things for yourself. Thanks for tuning in.